The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. We felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity, bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Now to inflation. Headline inflation, after moving above the upper tolerance band in October, has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Rising uncertainty in global financial markets coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. For the advanced tax payments for Q3, that did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit overnight liquidity, but also durable liquidity to meet the requirements of the system. The rapid digitalization of financial services has brought convenience to all of us, at the same time efficiency, but it has also increased exposure to cyber threats and digital risks, which are again getting sophisticated day by day. The surge in digital frauds is a matter of concern. It warrants action by all stakeholders. The Reserve Bank has been taking various measures to enhance digital security in the banking and payments system. Introduction of additional factor of authentication for digital payments is one such measure. It is now proposed to extend this to online international digital payments made to offshore merchants who are enabled for such authentication. The Reserve Bank shall implement the bank.in exclusive internet domain for Indian banks. Registration for this domain name will commence from April this year. This will help avoid banking frauds. This will be followed by the fin.in domain for the whole of the financial sector. The banks and NBFCs, I would urge them to also continuously improve preventive and detective controls to mitigate cyber risks. They must develop robust incident response and recovery mechanisms, reinforced through periodic testing for operational resilience. The various developments in financial markets and market infrastructure over the past few years, we shall be setting up a working group with representation from various stakeholders to undertake a comprehensive review of trading and settlement timing of markets regulated by the Reserve Bank. There are some 5 such markets which have different timings. The group shall submit its report by 30th April this year. I believe that it has served the Indian economy very well over these years, including the very challenging period since the pandemic. The average inflation has been lower post the introduction of this framework. Moreover, CPI has mostly stayed aligned with the target given under this framework, barring a few occasions of breaching the upper tolerance band since its inception. We in the Reserve Bank and the Monetary Policy Committee will continue to improve the macroeconomic outcomes in the best interest of the economy, using the flexibility which is embedded in the framework, while responding to the evolving growth inflation dynamics. Moreover, we will strive to further refine the building blocks of this framework by making advances in the use of new data, improving nowcasting and forecasting of key macroeconomic variables. We forecast, you are aware, growth, inflation, etc., because this is actually a forward-looking policy. And so we'll continue to do that and develop more robust models. To enhance access of retail investors to government securities, the Reserve Bank has taken a number of steps earlier. There's another step that I am announcing today, and this pertains to expanding the access of NDS Home, our platform for trading in the secondary market transactions for government securities, to non-bank brokers who are registered with SEBI. A number of them are registered with SEBI. They will also get an opportunity now to participate and trade through the NDS Home, the electronic trading platform of RBI for government securities. In view of the various developments in financial markets and market infrastructure over the past few years, we shall be setting up a working group with representation from various stakeholders to undertake a comprehensive review of trading and settlement timing of markets regulated by the Reserve Bank. There are some 5 such markets which have different timings. The group shall submit its report by 30th April this year.